All right. Good afternoon, everybody. Hello, hello. Welcome back. And just do a quick sound check. Um, do we have sound? Huh. Interesting. Interesting. Someone said the link doesn't work. The funny thing is, it worked for me. That's weird. Weirdness prevails. See if this works for anyone. I think Ben, you were asking for the link to see if the link works. It's funny. It works there. It works here, there, everywhere. It's kind of weird. I can't understand technology. Maybe there's no HTTP. I can't figure it out. But thank you for bringing it to my attention. It was kind of weird because we were going to just make that quick announcement. We're back live for something we haven't done in a long time. So let me double check. Why would it not go through? It's just weird, right? Yeah, it's the same link though. Ben, am I missing something about technology? I mean, I understand. I don't have to raise your hand. Did Apple seem to get a lot worse when you text something? Apple, it's just like anything you text turns into garbage and jumble. You know, instead of saying like the slot that is open to play golf, they say your slut is open. It's like, excuse me? I mean, there's some really monumental problems with Apple's texting. I don't think it's my fat finger, but problems. But anyway, I can't seem to get everything going from a technical perspective. I should become a tech genius with all the technicians I've been talking with. By the way, on a simple side note, we won't make this a long intro, but apparently Microsoft 11 has compatible non-compatible issues with 3D and TradeStation settings, and you got to kind of disable something to do with NVIDIA. There's a conflict between TradeStation, NVIDIA, and Microsoft 11. I just learned that today, by the way. Another new thing to learn over. Anyway, welcome everybody. What's going on? This is the monthly PUG meeting. It's actually your meeting. It's not my meeting. Several people asked questions. We tried to deliver some answers and give a general market overview using the person indicators. I don't really answer questions on other people's indicators because I generally don't use a lot of other people's indicators. The one that I would use more distinctly would have been and will be, and from time to time you see me using it in the live trading room, is George Lane's stochastic. I may take a look out of curiosity just to see what the masses are looking at, other indicators. And every once in a while, as we did today, take a look at Fibonacci. But to me, Fibonacci, not only, it's not just, I don't call it overrated, but it's over. I mean, when you look at pivots and you go, hey, listen, I got a monthly pivot support coming in here. And then by the time I draw like we did today, if you notice that in the live trading room, we put it in the Fibonacci overlay. It was like, oh, what a coincidence. So anyway, the long and the short is I think pivots are more reliable. I'm not saying Fibonacci is not good. I'm just saying it's kind of redundant information, and it takes more time to finally figure out what your swing high and low is to look at what your retracement level is. Anyway, that's just my experience, but I think once people get the hang of looking at pivots, and one of the reason I'm getting into this subject is one of our members have asked a question about something I brought up in the live room about using 2-day pivots, the difference between weekly and 2-day pivots, and you know what, I'm going to answer the question because not only is it is a good question, but we like the guy who asked the question to begin with, so we'll go there. And if you're not attending tonight and you listen to this recording, no other reason other than it wasn't really, it's not because it's a good question. It's because we like the guy. That should be classification of who gets questions answered anyway all the time. We generally like it. Anyway, here's a disclosure. Trading involves risk of loss. Anyway. Yeah, see now, Ben, there's a typo. You sued Toss and NinjaTrader. So I'm just joking around. You use them. That's okay, Ben. Ross, welcome. Thank you for being here. So basically what we're going to cover today, ironically, is the first question that we have. No, it's all good, Ben. I understood what you're saying. But you see, there's an example of where you want to make sure your word structure is correct, like slut and slot. You don't want to mix your vowels up there. It might not go over well. Everyone knows the typical golf joke. If your wife's, you'd prefer your wife to be a hooker than a slicer, but no one wants their wife to be a hooker, I guess. I don't know. All right, moving forward. Hook means your ball goes to the left, and slice means you come across the top and it goes to the right, for all those golf aficionados out there. All right, first question out of the box is, first question was 2-day pivots versus daily pivots. And we're going to, for that, they're the one platform that has it easily accessible, because I really was never a fan of 2-day and 3-day and 4-day pivots, right? It's daily pivots work very well for what I do. And if I'm looking for something, again, that breaks out of the norm, I use weekly pivots. Break out of the norm means if the market breaks out of its intended resistance, then your next level resistance might be utilized by using weekly pivot. But in the case of where we tend to see these kind of moves, where one day might be or maybe 2 or 3 days might be big range days, and then you get into a narrow range day, and then you get a breakout and then a narrow range day. The next day pivots, because the pivots are calibrated by the sheer range of the prior day. So if you combine ranges on a narrow day with a wide range day, so for example, yesterday was a very narrow range relative to the prior day. So let's take a look at what I'm explaining. This was not Ben Bernanke. Listen to me. This was Jay Powell's fateful pain. Americans are going to demonstrate pain. We're going to go through pain. Yes, we're going to have to do something about this inflation. Not that I helped create it, but don't worry about that. But we're going to eliminate it, because then you're going to have to go through pain. That was probably one of the most difficult presentations I wouldn't say difficult, it's a bad choice of word. That was probably one of the most distasteful performances by a Fed chairman in my 40 years of watching this stuff. And it was always wonderful to see Alan Greenspan. They didn't do press conferences back in the day, but Alan Greenspan, his vocabulary, his vernacular was so, when he would be called up in front of senators and on Capitol Hill, they literally had to get a dictionary to understand what the hell he was saying. I don't know if he did it on purpose, but you remember Alan Greenspan, the man famous for irrational exuberance term. So the moral of the story, we went from him, then we went to Ben Bernanke, who looked like a nice librarian professor, warm and nice and very concerning about life, prognosticator of the crash of 1929 and the role the Federal Reserve can play to make the financial system hold up with more integrity. And then we got Janet Yellen. And the first act she actually did an about face. Some people would call it a lie. She went in front of Congress and she said, oh, by the way, I'm here for the little guy. And less than 30 days later, her first act as chairwoman is, let's raise rates. Screw the little guy. This is all factual information. And then we come to Jay Powell, who for about a year and a half told everyone, oh, inflation's transitory, which anyone with half a brain, including most economists, including economists on the Democratic Party ticket, which is really bizarre, right? If you think about it, said, you know what? No, wage cost pressures is a part of this thing. Inflation's not going away. What are you, nuts? You got to do something. And he refused to raise rates, and he kept using the term transitory. So he got the whole mandate with the Federal Reserve wrong there. But then, and I'll clean up the story real fast, and we're ending it right here. He comes out Friday after all this time and through the last year and a half, and then says, he was not happy. He looked mean. He didn't look like his normal, professionalist self. Maybe he woke up on the wrong day of the bed. Who knows? But he literally, no one's really heard a Fed chairman use the term, it's going to be painful going forward. And I mean, he wanted to make sure that that was understood because he used the term twice. Anyway, with that stated, the market plunged at that point. That's what created that big red bar. The next day was yesterday, Monday. We would have expected a much wilder follow through in the marketplace. And so if you're trying to predict what the next level of support and resistance is, we can look left on a chart and say, gee, we got an area of old price action in charts. I mean, I could just take a look at old lows, market penetrated near a low. The average of the lows is right around in this area, in the S&P is around 39, let's call it 39.30. All right, moral of the story is, how are you going to come up with that? Well, what you can also come up with is what we use in pivot studies. And the question on the table right now is, when would two-day pivots be more beneficial? Two-day pivots are more beneficial when you combine one day and another's range, and then you get a two-day pivot. So how do you find that? The solution is easy. You use Thinkorswim. You go to study. You can use John Person's indicator, and you go to Person's pivots. And then what comes up automatically default are daily pivots. Now, think of the logic. If you're looking at a daily pivot, it gives you a plot for one day. And if you have a daily chart like I do, you're going to see nothing but dots. So most people don't understand what to look for or what happened. They just look, what is these squiggly lines? What does all this stuff mean? And the bottom line is, a daily pivot would be good for what? Intraday analysis. So like a intraday would be anything less than day. So 4 hour, 1 hour, 30 minute, 15 minute, et cetera, et cetera. The Person's pivots, just as a reminder, what makes this a powerful tool is that it gives us a highlight at the end of a period, what the next period's condition is going to be, bullish or bearish. If the market's truly bullish, it will give you a projection of a higher pivot, a higher red, and a higher or equal green. That gives you the inclination the market is bullish. If the market's truly bullish, the market should trade north above the actual pivot, which is the fuchsia line in this case. Now, I don't want to get into a Thinkorswim class here, but it's real easy to color coordinate and customize what pivots you're looking at and what they mean. Just go into the study app, edit the study, and then you can go into, we've got day pivots right here. Go to the little settings wheel box. And when you have the pivot point, it's got a color code of fuchsia. So if you want to change that to a, say, light blue or gray color, whatever that is, I'll go bright blue. You can change it to bright blue. I have pivots. The reason I color code my pivots is because I want to easily see on the chart what the difference is between the daily pivot and maybe the weekly pivot. So sometimes you come on my charts, you'll see multiple colors. I'm looking at whether the daily pivot is greater than a weekly pivot, and that tells me the market is bullish. If short-term pivots above a higher time frame pivot, the market's bullish. So how do we adjust for wild range days when the market's crazy one day and then the next day is a narrow range day? Things can get out of whack. And for that, if you just go down to where it says time frame and it has day, you have 2 days. So in essence, this particular question had to deal with, when would I use 2-day pivots and why? And when I would use them would be when we have a combination of a wild range day like we did Friday, and then use the data from Friday and then the data from Tuesday, which was a Monday, Friday, Monday, which was you add the average of the high and the low and the close of those two periods, and you're going to get the next 2-day period pivot combination, and it'll give you an indication of what the potential typical range is. So this would work for obviously today and again tomorrow, 2 days. So the pivot projection that we see here is in the ES 4166. The pivot is 4086. And then the actual support is down here around 3876. Ironically, we have a little bit of a difference in spread between the actual support level, which is around 3930, and again, 3876. So tomorrow, possibly, if the market truly is bearish, we'll probably see its destiny fulfilled of a move to the downside in here. So that's when you would see it. You want to heighten more time frame to see are they reliable. Here's a look-see of 2-day pivots in the S&P 500. So if you're looking to capture not just the trend direction. So here we have a market that closed and it has a lower high and a higher low compression. That means something's kind of changing. And as we went through this 2-day period, notice that the pivot point for that 2-day period here, so that would have been Thursday, the 18th, and then the 19th, right? As we see this 2 days, pivot actually acted, the pivot point acted as resistance. So just as a reminder, this is something, and I do want to reemphasize that we put up a post. We're having as an announcement. I'll do a little bit more about it, but just to let you know, we're doing a 2-day seminar. We haven't had 2-day seminars in a long time, and thanks to COVID, of course. And so this December here in Palm Beach Gardens, we're getting the band back together, guys. We're doing a 2-day seminar. Should be pretty exciting, and hopefully we can do a pre-market or a post-market event for those willing. A couple of years ago, we took some people out on my boat and we went out fishing a couple of days before the event. This year, we've had a request for golf, and so we got to get golfers together and go out to play golf at a Jack Nicklaus design course out here at a club in West Palm Beach. So that might be something that would be fun and thrilling and a good time. So a golf outing and in addition to the 2-day seminar. But that's something we can obviously shore up as time goes by. But just as a reminder, the kind of stuff that I'm sharing with you right now is exactly something that you've heard before at a seminar I've ever given, because this is my stick doesn't change. This is the analysis I give. And the one takeaway right now of what I'm saying is the pivot point, which is now I've changed to represent blue. In a very bullish environment, the market will be trading north of pivot. In a bearish environment, the pivot point acts as a resistance level. So that's been my identification for the last, say, 30 some odd years in using pivots, that the market, when it's really bullish, it trades north of pivot. When the market's changing and something goes wrong, the pivot point acts as resistance. So when would 2-day pivots best serve you? When you go through a period of 1 day of massive wide range movement, and then the next day a narrow range, add the two together, forward project out, and you get a more compelling filtered look of the overall market. I still to this day prefer 1-day pivots, and then I use the weekly, and that's what you find on my charts. I'm not to say that the 2-day pivots can't be helpful. They can be. I think that overall, you can clearly see that in the small sample of data in a market that's gone, like, say, sideways, it's trended up, it's gone down, it's gone up. It's kind of bizarre. It almost looks, and then the market's gone again down. This has got, in this small sample of days here, you've got 3 of the market conditions that you want to see a sample as. How did it perform in sideways range? How does it perform in bullish days? And again, keep in mind that these are not lagging indicators. They're predictive in nature because it's based on the close value, and it projects out what the next 2 sessions are going to be. So tomorrow, when the market closes tomorrow, or on the close tomorrow, which coincidentally is the end of the month. Let me go and clear all the drawing here. And clear drawing set. And clear. There we go. So at the end of tomorrow, and I believe we can go right over here to the, I think the change right expression settings. You see where I clicked right here in the 2 little wide arrows right there? If you click on that, you change your expression. It's asking how much expansion area do I want to the right of the bars. I'm going to put 20 for right now. You'll see why in a second. So it just expanded 20 bars to the right. So I have to go, because this is ES and it's all session, meaning 24 hours. Here we go. So let's pretend tomorrow this is the close tomorrow. It's not, it's closed today. But let's say pretend tomorrow. At the close of the market, the pivots are calibrated, and that's why I wanted to just give you an easy access or understanding that it's a leading indicator. These lines aren't put in as it's happening. They were put in before it happened based on past price action. That's why they're more of an actionable, powerful leading indicator, probably the best in the world that we have as far as a technical tool that's more likely to be underrated and underused by the masses. Because most people don't, they don't understand it. And then they look at the chart and they go, oh, you must have drawn that stuff in there. No, it's in there beforehand. So that's what the nature of pivots are. So you have a lot of different opportunities, and you can take a look at some markets as a disclosure. Some market adhere to pivots better than others. Thinner market, lighter traded markets don't really respect the pivots if they have too many narrow ranges, and that's where you can use higher time frame, and that would be in the case of using 2-day pivots, might be something more apropos. What would be, I don't know, something like like maybe oats or corn or sugar or something like that, maybe, or a stock like I don't know, something that doesn't trade, and I can't come up with an example off the top of my head. I was going to say something like some obscure utility stock, which NEE comes to mind. Something that doesn't have a lot of volatility behind it, meaning big price swings every single day, right? So 2-day pivots might be more in line to be using on a utility company, so every day doesn't really move, but every 2 days you might get, average price swings. So that's where a 2-day pivot might give a little bit better look-see into the future. So I hope that information fell on good ears. All right. Next, if we go back to going to studies here and we edit the study again and we go back to the pivots, and you can change that. And I'm going to change that back to 1 day, daily. There it is. And then if you don't mind, I'm going to change back my fuchsia color. That was my color. There's fuchsia. There we go. And then I hit apply and I put everything back to where it belongs. Okay. So, a daily pivot just kind of shows the same kind of information. And for the record, I just want to compare the ES for you, and then just go over that theory. Sometimes, so for example, here's where we came into a bearish day. The market gets above pivot. And something obviously happened, and again, that must have been a CPI. I'm going to bet you that's a CPI number. The market's supposed to be bearish, and it trades below pivot, and all of a sudden, economic reports come out, and it changes the whole landscape. At the close, the market was projecting for the next day, a higher high, no joke, and a higher low. So that you can see where it's connecting the dots to project that. And then the market kind of respects its pivots more times than not. If the market's truly bullish, the pivot point, the fuchsia now, should act, and the market should trade north of pivot. The pivot should act as support in a bullish market environment until things start to change. And then you notice that the pivot point right here, the fuchsia line, starts to act as resistance. That's kind of like an interesting concept where the market goes from a kind of a bias of a bull trend to it's changing, let's call it sideways. And either we're going to resume the trend or we're going to reverse the trend, right? And so if the market trades south of the pivot, which is the fuchsia, you got to kind of respect the fact that the market's going down. And as we had on Friday, something can change the nature of your prediction. In other words, from Thursday, it was predicting a bullish day for Friday. What changed the prediction? Jay Powell. Jay Powell saying there's going to be more pain and interest rates going to go up will tend to change the landscape of a market outlook, generally, right? And so we had on Monday a downward draft with a wider range because Friday was a big range. And so sometimes what can happen is due to 1 day's massive change of value and trading range, it will alter the next day to suggest, hey, it's still bearish, but man, if today or Monday has the same type of range that we had on Friday, here's the kind of wide range you can expect. So that's where, again, 2 things to take away here. Pivots, the fuchsia line. If the market's truly bullish, markets trade north of pivot. If the market's truly bearish, it'll trade south below the pivot point. And if you get something that alters in between a day and the market gives a sell-off, you can sometimes wait that second hour because what happens is you can get an equal and opposite. Markets go down, they come right back up. So generally, that's a timing element to wait to see if the market respects its massive breakdown. And the one thing we didn't talk about is volume conditions, on balance volume. This is not a seminar. This is just talking about the questions at hand, which is the pivot point. But I thought it would be very important to say, listen, it's not just about the pivot points. When would you use 1 day versus 2 day? Number one. And number two, do I put 100% of my faith in one indicator? And the answer there is no, not at all. Pivots are very good in giving me a leading edge in what the market prediction or condition, not prediction, let's call it condition is. Is the market condition in a bullish trend or a bearish trend? And if it's in a bullish trend, then I want to look for spots to buy against support. And then I want to look for that condition, if it's supposed to be bullish, to maybe be nurturing a bullish outlook by trading above the actual pivot. And then I can look for trades in that direction under that condition. Again, in that direction and under the condition. Condition is bullish, then I want to look to be a buyer when the market's above the pivot. Okay, so those are some very profound and powerful ways of looking at the market and having a systematic way of trading. Again, you're not going to catch every winning trade. There's going to be things that change outlooks. This was a bullish outlook that was changed by Jerome Powell. This was a bearish outlook that day that was changed by a CPI number. But on average, almost every day, you get the pivot point analysis that helps keep us grounded in the marketplace. And that's where we can understand the better use of pivots and pivot point, and especially person's pivot analysis work. So the way that, when I had mentioned, I don't really traditionally will use 2-day pivots all the time because I have mine programmed for daily and then weekly. If you look at the higher time frame for day traders, if you're day trading E-mini S&P and that's all you're doing, then I would absolutely employ you to look at 3 things. If you're a day trader and you're trading only E-mini S&Ps, use the 2-day, because we do get these wide range, then narrow range combinations. Big range breakout, next day, small range. Using 2-day pivots might be more efficient in that regards. Use the dailies, use the 2-day, and then obviously use the weekly, which I'm going to show you here. And we're just going to turn on, I have them turned off for silly reasons. Double check here. No, they're on. It should work. And we hit OK, show the study. There we go. Hit apply, and we should have weekly pivots. There we go. And hit OK. So in a given week, if the market's supposed to be bullish, oh, what a combination. Market in a bullish environment stays above the weekly pivot until it trades below weekly pivot. Something is wrong, right? So we have a combination. If the market is trending and if it's supposed to be bullish, it should be above weekly pivot. When you start to get your daily pivot points below weekly pivot, you don't have to be a rocket scientist and say, gee, let me buy the dip here. You probably should be saying the market condition is bearish unless something changes, either a buy signal, or we're at support, or we're extremely oversold, and we can look for a bigger bounce. So it's ironic that we had at around that 39.30 area. If you recall a few minutes ago that I had up on the chart, I believe we used that 39. It was 39.30, somewhere around that area. And so right in here, old support around that 39.30 area. What I look for when using weekly pivots or daily pivots, or any pivots for that matter, I also look at old points of interest on a chart. So an old point of interest on the chart, old, like this week's pivots are based off of last week's price range, not way back in July, okay? But in July, the market had this area of old support, and then it broke out right in here, and it came in right around this level. So what's interesting is we are actually near a weekly pivot. We're near that 2-day pivot level. And more importantly, some old price action here. And there's some pretty strong, compelling evidence of support down in here. Now, if we take it a step further, and I will not keep you in suspense, for me, if a market is supposed to be bearish and it gets down to support, and if it's very bearish, we probably should see volume share that point of view, meaning more people want to be short the market. And if more people want to be short the market and there's more heavy volume towards the downside trend, then on balance volume as an indicator, leading indicator for volume, should start to trend lower. There's an old precedent phrase that we use from technical analysis: volume precedes price, either up or down. So if the market's going to break out and start to go up, volume will start to lead the way up. Volume trend will start to lead the way up. The volume trend was going up prior, as you can see. The market hardly moved in here. It was overnight. But before that report came out, volume was unprecedentedly higher. And I'm connecting a dot. This one bar is where we were at that plot. Prior to that bar, volume was almost leading the market. It was preceding the market higher. So the market comes into support and someone would say, would you sell that low? I'd say, I don't like to sell support. We're right at support. We're at weekly pivot. There's a lot of support in here. And I would say, I'm not a big fan. When the market starts to move up or move sideways, maybe some short covering, you're not going to get that kind of dramatic move. It almost seems that someone may have had better information or a better point of view that the report that was coming out was not going to be that bearish, if that was what it was. But as you can clearly see in here, hopefully you can clearly see, from this point on the chart to that point, the volume was sharply higher. It's bizarre if you can see that move. So volume led before the price broke out. And price, as it moved higher, the volume confirmed that price action as being relatively strong. So we come over here. If that's what it looks like on an uptrend, on a downtrend, you should see volume sharply lower. So I asked myself, why the heck, if we're this low in the market relative to a week ago, here we were at 4,100, and now we take a look at the market here at 3,960. I mean, that's a pretty big difference in price comparing low to low. Volume is not as significantly lower. So I'd have to say we're coming into some support here in the pivots on weekly and daily. And it wouldn't surprise me, based on some other analysis that we shared in our live trading room, that we get some kind of a bounce from this area tomorrow, if not Friday, or ahead of Friday, I meant to say. Tomorrow, if not ahead of Friday's unemployment report. So that's my 2 cents. What is pivots going to do? We're getting into an area of support. The market's fallen. And volume doesn't look like it's really conducive for a market complete meltdown. Not to say it can't, but I would say I would lean against maybe a market bounce, or not be selling short by any stretch of the imagination. Let's start there. I wouldn't be selling short right now in the market based on this condition. That's my 2 cents. So that's what we have. All right. I hope that answered your question regarding pivot points. Okay. Let's go over, and we're going to do what? Clear drawing set. We don't need any of that drawing set stuff in there. All right. What we also wanted to look at was why didn't Powell discuss out of control fiscal policy? Well, George, I can't get into that, even though this is, and I've said it before, and it's hard not to be political. And because this is a very political market environment, and what you just mentioned, fiscal policy is directive of fiscal policy. There's two things that run monetary, let's call it stimulus. One is directly from the Federal Reserve, which they can do what they've done with quantitative easing by buying hard assets like mortgage-backed securities, which you buy something, that means you put money into the banking system, right? You're taking the product off, but you're replacing it with cash. So that adds liquidity to the market, which makes money cheaper. And then you drop interest rates on top of it. So that makes money even that much more cheaper. So that's monetary policy, and that's part of the Federal Reserve. And that's why everyone wants to know, well, okay, great. You're going to raise rates. You're going to make it more painful for Americans. But what are you going to do with the $9 trillion the Federal Reserve has been buying in assets since the housing crisis? I mean, for God's sakes, you're telling me all this time this economy is based on the Federal Reserve buying assets boy, we would like maybe China to buy some. Japan could buy some more. I mean, maybe Americans could go through and buy some more savings bonds if the yield was greater than the rate of inflation. But that's not going to happen. That's a topic of a different day. Then there's the, as you mentioned, fiscal stimulus. More entitlement programs, the Reduction Inflation Act of paying people to not go to work and all of that good stuff, and the stimulus money and the PPE money, all of that printing is really what's added to inflation. Most people think it's energy, and that's not true. And if you think about it for a moment, we had $150 or $130 barrel of crude oil under the Obama administration. We didn't have inflation then like we have now because we weren't doing fiscal stimulus. Another point I want to make to everybody, if you want to be your own market analyst and probably scratch your head and think for a second, there's a small little cereal company called Kellogg's. The stock symbol is K. All right. Kellogg's has nothing to do with energy, right? I mean, they produce cereal. Their last earnings conference call, they made more money than I believe Exxon did in the prior quarter because their input costs were less, so they were able to raise prices. So, that's great for a shareholder, but they raised prices. What do they sell? Cereal. Who buys and eats cereal? I don't know, maybe some grown-ups, but kids a lot, right? So families that need to feed kids cereal are being maybe not because the hard input costs went up, but they rose and raised prices because why? They could. And they did. And they made a lot of money doing it. So again, Kellogg's is an example. I'm just not that I want to pick on any other company out there, but it's not inflation because of demand. It's because people are raising prices because it's a thing to do. And Kellogg's is one name. So I'm just providing you with facts, and that's partly, not to get into fiscal policy, but there's a fact of our business segment. Why isn't anyone saying, hey, Walmart got punished by keeping prices lower so they weren't gouging people, right? In the rollback program, they had a little situation. Their earnings were less, and they said, hey, we're not raising our prices. We still made money. Maybe the market didn't like that, but that's okay. The moral of the story is simply that when we take a look at some of these companies and their earnings and what they're saying, who's making money and why, and where's the inflation coming from? Anyway, that's another topic for another day. We're here to discuss the pivots and PUG and how we use our indicators in trading and making good, sound decisions. Because we all know, hopefully you do, that the easiest way of trading and the safest way of trading until you get caught is insider trading. And we don't really do insider trading, right? What we can do is use indicators to say, what is the market as a cumulative value? There's always somebody out there in this world that has better information and maybe inside information. Who knows? But there's at the very least an accurate statement. Somebody has better information. And for me, when I look at and in this particular chart, which is a 4-hour chart, so let's change it back to a 1-hour chart. When a market's going down, just like the broad market, if it's going down, if it's going to be bullish, it better start trading north of the pivots, and that's these fuchsia lines. And as you notice, we ain't trading north of the pivots yet. And as it's going down, there's not a lot of volume trend in the market. In fact, volume is actually sideways. So it would be, in my humble opinion, looking at a volume trend and then looking at the pivot analysis when the price action is dictating bullishness. And if the volume action supports that outlook, I'll be a buyer of a stock like Walmart all day long. And what's ironic is where's price relative to its pivots? Right on it. So it won't take much to get the market to trade north of the pivot in higher volume trends. So again, when you get a market that's trading north of the pivot point and it's a bullish environment and you got volume trends rising, you can probably see that you can get, and this is again a daily chart, whether it's a swing trade or more of a dynamic trade, markets trade north of pivot is a positive thing to be along with, especially with confirming evidence of increasing volume with that trend. So anyway, that's my little 2 cents. And again, George, I don't really want to touch the whole politic thing, but fiscal stimulus, having too much stimulus, and it almost one hand washes the other. What just may have transpired with the Inflation Reduction Act, which, and again, the whole thing about giving kids money for college education, and how it's being paid for and all that that's a topic for another day. But if interest rates are going up to tighten, to reduce inflation, you can't have printing presses and the government still pushing out money. And you're absolutely correct there. Okay. And I don't think he wants to say anything like that in an 8-minute and 38-second speech. So all I can tell you is this. I based on today's action, and I'll share with you what we said in the live trading room, is that the way the market's trading, and for that I'll have to turn to TradeStation right now. So TradeStation has this really neat way of lining up everything I kind of just talked about, and it's color-coded. One of the things that we did in creating the concept, if the market's truly bullish, the market would trade north of pivots. So we color-coded, excuse me, the pivots. So this is these columns right here, which say pivot W stands for week, the pivot, the support, the percent of the distance between the current price and the resistance or the support. So we could figure out real quickly, gee, if the market goes up to resistance, how far away is it from current pricing? So let's get a real stock. Let's take a gander here at something I have a special interest in wanting to go down right now, and that's Oxy. Not right now, but between now and October. So all of the energy sector, as you can see, is blinking big time red because a lot of stuff generated daily sell signals in the energy complex today. All of the stocks are, for the most part, whether it's Apache, is at its pivot. How do we know that? Here's Oxy on the chart. I just punched up Oxy, and the blue line right here is exactly where the market is. It's relative to its weekly pivot. So if a price column is highlighted blue, it means that the price is trading right at its pivot. Now, does that mean it's bullish or bearish? It means it's neutral right now, because if it starts to trade below weekly pivot, then it becomes bearish, right? So the moral of the story is we're starting to see before our very eyes the market in the energy complex start to roll over, but almost everything is trading at or near its weekly pivot point. So during the day, I look at my short-term page and I start looking at, well, where's thing in relationship to its daily pivots, and what's kind of changing. Now, this might be a little too much information for someone that's just walking in and never heard of John Person before, and I do apologize for that. But it is something that's impressive that I know, have trained, and I can train people and do train people to how to spot this. What we're looking for is the market getting ready to be a buy or a sell? Is the market generating daily PPS buy and sells? And what is the market condition? Is the daily trend bullish or bearish? It says it right here. Uptrend, bullish, until it changes. So that is kind of like with TradeStation, a very unique function of their radar screen. We were able to take the work that I just did manually with you with Thinkorswim and put it in a constructive format that is more systematic. So I know exactly going up and down my screen what stock is starting to roll over. Is it near support? Is it breaking pivot? And if it's at pivot and it's going to break and go down to support, how much more percent change do I have to take up an opportunity? And so in the case of today, we were talking about Apple. If you guys were in the live trading room, and we said, support down around around 153-ish, I think is what we were talking about. So let me get to Apple. And as you can see on my screen, I list everything pretty much by sector. And let's get to Apple. It should be down a couple more scrolls. Property, casinos, social media. I might have already gone through it, but it should be here. It's in a few spots. Oh, Lord, did I just blow right through it? It should be in here. I've got Apple there. There, watch list. Fine, good enough. So if we take a look at Apple, to its support, that's the daily. We wanted weekly, stupid. Excuse me. Didn't mean to waste your time. And you'll see this in a second. It's kind of neat way of also looking at, what's ruling the roost of the market. And at the end of the presentation, I'll give you a couple other little things that I think we all should be paying close attention to. All right, so we know that the support, we're at weekly support 158. It's already there. So 158, we've got a 3-period pivot point moving average. And someone is going to ask me, what are my moving averages? There's a 3-period pivot point weekly moving average. The prior support pivot is around 153. So older support comes in right between 153. So we got to get through this support. So if I was going to say, John, am I very bearish Apple? The answer was no, not from here. We were in bear put spreads up here, and we covered them, but the bottom line makes a little bit of money. The point here, shameless plug, the point here is I'm not all of that bearish in the hole here in Apple right now, bottom line, because we hit near pivot support and there's higher time frame support around 153. Now, that doesn't mean in time meaning, a year from now or 6 months or 6 days from now, we can't crash and burn and go to zero. But as it is right now, the odds are we get a dead cat bounce, or at least some kind of a bounce if it materializes into something. And I can say, gee, where are we in relationship to support? I think Apple's bearish. I'm going to get short. And you figure out, wait a minute, it's at support. What? I don't want to sell something at a weekly support. That's where coming up with ideas that it's ironic that when bearish the market, but something's at support, maybe it keeps you, and then you can kind of examine it a little closer and say, well, what does the higher time frame chart analysis and conditions suggest, such as volume? And the other tool that's very, very extremely powerful, and everybody should absolutely learn how to use, the relative strength PMC tool. There's just no excuse for it. And what I mean by that is, if you have a market that's up near pivot resistance, by the way, and the volume is looking notoriously negative, and your relative strength is weakening as the market makes higher price structure, that's not a good combination. You're looking for a pullback. Now that the market's pulled back, now you got to answer yourself, should I be selling the market, or should I be out of my shorts and I should be looking for maybe a key reversal or some kind of stabilization in pricing? And that's where pivots can help us. So pivots can help you, but how do you look at, if you're only looking at 1 or 2 markets, then having what we've started with, like, for example, the ES, having your daily, 2-day, and weeklies is just fine. But if you're looking at equities and trying to say, where's the next big upside trade coming from? What is the market condition? Is something capable of going up after a pullback? Let me rephrase that, or restate it. If a market rallied and had a correction, the likelihood it could see another upswing is pretty good. So we want to know from where is the market come from and to where is it at now. And if it's at a higher time frame support, like weekly person's pivots, and the short-term or near-term conditions such as momentum study and volume doesn't suggest the market is really going to get crappy, I mean, we could see a little dead cat bounce, I would refrain from selling short in the hole. And that's where your pivots are very instrumental in helping. Now, can I tell you based on what the chart is in front of us that we should go long Apple? No, but maybe if the volume action starts to get improvement and the market consolidates and we get a leadership role where the volume starts to trend higher and leads price, and we start trading north of the pivot again, remember, even with Apple, if the market's truly bullish, it'll trade north of its pivot points. In bullish market condition, blue in this case is the pivot. Blue is pivot. Blue is pivot. In a market bullish condition, market trades north of pivot. When the market's bearish, it generally tends to trade south. The pivot acts as resistance. So again, I think that using pivot points whether it's a 60-minute chart using, again, your daily pivots, or whether it's a daily chart using your weekly, or your weekly with monthly, or your monthly with quarterly. Either way, you just check your time horizons, and that's why I have those specific charts on my screen. My 5-minute chart, my 15, and my 60 are all with daily pivot points on them. My daily has the weekly, my weekly has the monthly, and my monthly has the quarterly. Now, with that said, let's finish this up. And I think it's a good refresher course because we've gone through listen carefully, a very visceral, which means emotional market, headline, news-driven market. Fed raises rates, Fed cuts rate, inflation this, inflation that, stimulus, no stimulus. I mean, it's been left and right. It's been hard to navigate the market. It's been extremely wild, except for one instrument, one market analytic study I want to share with you is seemingly missing amongst analysts. And it is the condition of which the market is trading. If anyone noticed the condition of which the market is trading, I mean, we haven't seen a 30-handle 10-day ATR for years. We've been in 180. We've been in 250. In fact, in the crash of March of 2020, the 10-day ATR was 249 points. On average, we've been about 100. We're starting to contract. The 10-day average true range lately it's starting to climb because of Friday and the last couple of days. But the 10-day ATR started to contract. And when the 10-day ATR, if you notice this, if we're so bearish, the ranges aren't really that bad anymore, right? It's not like we wake up and it's 2% lower, 2% higher, and just nuts, right? We've kind of gotten away from that. And that's kind of interesting because then as ATR or volatility starts to compress, it makes fund managers a little more comfortable that they can manage their risk, and the dust is starting to settle and they want to dip their toe back in the long side of the market. So one thing that I will notice, even with the sell-off that we've seen in Apple, Apple's sell-off started well ahead of Jay Powell's statement about 5 days before. One of the interesting aspects is that if the market starts to show narrowing or contraction of its volatility, it makes it feel a little bit warm and fuzzy. I would have to say the consensus of the market right now is very bearish after Jay Powell, who wouldn't be bearish. But the funny thing is the technical condition and the undertone of the market and the person's pivots analysis is not suggesting a very strong bearish market environment. It's bizarre. We have a distinct way of examining markets, and one of those is what we call advanced decline. And this is the work that I do. Many of you see this every single day in the live trading room. One of the weaker segments of the market is got to be in the Qs. It'll probably be the last to which I would say, based on just one form of analysis, and that would be market breadth, advanced decline, comp ratio lines. The one segment of the market, which might mean that mega cap stuff only falls less, it doesn't rally as much. And there might be other areas in the market that do better. More beta-weighted stocks to SPY, which would be the financials, banks, for example, insurance companies, et cetera, things of that nature. If I'm right, we are getting, and I pointed this out in the room, and I want to share this with everybody here. This is Sherman McClellan's modified oscillator, the McClellan oscillator. It's modified because McClellan oscillator is based on the moving averages and using breadth. You can go look it up on Google. And it takes the data from the NYSE, the New York Stock Exchange Composite Index, which we don't trade. About, 15 years ago, I said, well, if we're not trading it and it's pretty good, why don't we use it for the other markets? So I worked with Genesis Trade Navigator, Pete Kilman to be exact, and we created it, and then we converted that into with TradeStation. So we broke down the advanced decline concept of the oscillator, and we broke it down using the Dow, the Russell, the NASDAQ 100, and the S&P 500. So most platforms don't have that. I created this. This is a proprietary kind of thing. We changed the moving averages structure because there's not 1,700 stocks in the S&P 500 like there is the NYSE. So basically, we have a modified. That's why out of respect for Sherman McClellan, did not call it a brand new John Person indicator. It's the JP Mick oscillator, so that we know that it's based on purely data from the S&P 500. Okay. So what's interesting is, where are we in the reading of past historic levels? We're getting near an extreme oversold level. And every time we've gotten down near that extreme oversold level, we've had rallies. Some have been better, some have been less than better. But every time we get near an oversold condition, we get a market rally. We're at significant support, both higher time frame, which again is monthly, new month comes up, and we have weekly pivot support we're at. So I would have to say, based on the current market condition, that we're probably more prone to see a short-term rally this week ahead of the unemployment report. And I mean, if somehow we don't see the volume completely crap out and the market completely digress and the breadth of the market completely go to new all-time levels. I'm not saying there's not room for a little bit more downside. I would say that this correction that we see is probably less likely to be more severe. And that leads me to the only other thing, thanks to George Valle saying, hey, Jay Powell. Jay Powell didn't mention fiscal. So here's the only thing. What if Jay Powell was so mean on stage Friday and said pain that he really didn't mean it, but he just wants the market to do the work for the Fed? And maybe it's a head fake. I don't know. But I can tell you this. We didn't really get from Jay Powell's commentary a real big major crash in the market. I mean, it really didn't go very far. If you think about it, 411 to 398 is not really a huge move relative to what we've seen before. The most monumental negative statement I've ever heard out of a Fed chairman may have already been built into the market, and we need to look forward. So I would have to say, technically speaking, we're at pivot point support, which is a major head scratcher for me, okay? Because it's projected a bullish bias. Now, it'll be interesting where we close tomorrow, because tomorrow is what? The last day of the month? So you want to look at your monthly signals and look at where we go for monthly pivot analysis, which you can find, again, on Thinkorswim, as well as TradeStation, Genesis, and a few other packages like HDSI. One of the other things that we put together in this radar screen that many of you, I'll just share with you, is both high close, low close, and PPS signals, just like weekly. Something's blinking, that means it's going to be generating a weekly sell signal. We don't know until the end of the week, okay? So, but what we do know is that tomorrow represents the last trading day of the month. And what's interesting is it's kind of weird that XBI did cross a threshold, and it's at a threshold populating, and that's the biotech, S&P Biotech, a monthly buy signal. So as far as sectors, there's not a whole lot out there that's generating a lot of new buy signals. I don't trade Bed Bath & Beyond, but if you want to, maybe I should start. But it will generate a monthly high close doji, if that means anything. We have Lennox International is changing its scope and will be in a monthly PPS buy signal right here. So we've got a reflection of a change of some weird names out there. There are a few Air Products, Worthington Steel. You've got EOG, which is more natural gas related stock, not fossil fuel, with a potential monthly high close doji moving forward. ConocoPhillips in the energy. We've got RIG. We've got Goldman Sachs, one of the few financial companies that may generate a monthly buy signal. Pretty weird if you ask me, right? And then you've got a few others like Aflac and the insurance, Cardinal Health, Raymond James broker dealer, by the way. You've got a broker dealer near its all-time highs. How bearish can it be for that particular stock going forward? So again, we've got a lot of interesting changes coming up this month. UPS, and again, it all depends on, these things can get negated if we open up 1-2% lower tomorrow and these stocks unwind. But we're starting to see something weird. If the market was truly bearish, Palo Alto Networks, not only is it up and near its darn not far off its all-time high. Let's be honest. That's the high, and that's where we're at. It's not far off its all-time high. And we're going to form a monthly high-close doji. That doesn't want me to be too bearish in that particular stock. So there are some opportunities. There are some bad news here, which is interesting because Budweiser is just plunging. People just probably aren't drinking Budweiser. They're just maybe drinking more hardcore tequila. I have no idea. Cisco, restaurant business. That's Cisco Systems. They deliver restaurant foods. Maybe they're too big. Maybe they're expensive. Maybe things are dying out in the industry. I have no idea. I can just tell you that when something rolls over and generates a sell signal, relative strengths weakening, it's not something I'm going to look to be a buyer on. All right. What my point is to you is that we're getting a lot of changes of new, fresh monthly buy signals that you wouldn't think we would get in an environment of rising rates, as well as a Fed saying more pain for Americans, like GM in a monthly buy signal. So anyway, I just wanted to go through this list with you to give you some food for thought, what to look for. And again, I'm kind of glad that this has been recorded. Foot Locker was a trade we did for an earnings play. Fabulous stuff. I didn't know whether I knew people were going to buy sneakers or stuff for back to school. I mean, kids grow. You throw water on them, give them a Pop-Tart, and they grow. I mean, you can't really cut the top of the toe off from a kid and send them to school unless they want to do it and unless that's cool. But, I mean, generally speaking, kids grow and you got to buy new shoes. And then they have these extracurricular activity, maybe soccer or hockey, and you got to buy new stuff for them. Anyway, Foot Locker, I didn't know what the new style was. It going to be, who was going to be the leader? Was it Nike, Adidas, Puma? I have no idea. Keds, which is a company, parent company is Wolverine out of Michigan. Keds are still, high tops are still popular. But this is a company that said they did well. And if people like their service and like that store and like their deals, they're more apt to go in time and buy more. Anyway, the point is it's forming a monthly high close doji. It had a great earnings report. It's had a couple week pullback, and maybe the market, the dust is settling there, and it might provide against pivot support a good re-entry on a long position somewhere near this middle of the gap and somewhere near this lower 33, 34 handle, right? Anyway, it's forming a key monthly reversal. It's a long-term buy. You're getting a lot of different new, fresh signals in certain sectors. Drugs are supposed to be doing good, and obviously we're getting a lot of new, fresh sell signals. Obviously, that last one was Bristol. Was that was who was that? AbbVie was it AbbVie? Who was that just had that? Oh yeah. Oh wow. Sanofi. So there's some shell shocks there. So when something gives a monthly sell signal and it's below pivot, I generally try not to buy it. When something's in a buy signal and it's above pivot, I generally try not to sell it, and I generally try to buy it. That's the takeaway. So person's pivots is important. End of time periods are important. Tomorrow is an end of a time period that's very important. It's the end of the month. It's the last day of the month. Final note, a lot of different airlines is really weird, and UPS generating new fresh buy signals. And so that's kind of and I can appreciate UPS and I can appreciate some changes happening in some of the airline stocks right now. They're not falling as much. Nothing's got a definitive buy signal right yet. But I would say energy pulls back. You might have some upside out of some of the transport sector, specifically airlines, as we were saying in the room today. Over the river and through the woods to grandmother's house we go. That's Thanksgiving. It ain't that far off, my friends. So this is the last PUG meeting until next month. Next month we'll come back. We'll see where everything turned around. I thought it would be important to kind of take a look. Which interesting last one is DraftKings. This is one we gave it out in the live room. The doji is over here. The high is, I think it's 1588. I think it is. The high is 1588. I was right. If we close greater tomorrow than 1588, we have a higher probability trade for DraftKings. Now, I joked around, and I'll share the joke. In the summertime, you probably want to, different sports. There's probably not heavy gambling on women's volleyball. There's probably not a lot of, and jokingly I said today, I don't think that it's not a bad sport. It's very hard, but men's water polo, a hard sport in the summer. It's a hard sport. but doesn't attract a lot of gambling. But football season, which the opening college game of Notre Dame taking 17 points because they're playing Ohio State, by the way. And I know there's somebody out there going to say, go Buckeyes. I understand. OHIO. But Notre Dame, I think you got it. This is going to be an exciting game Saturday night. But DraftKings, with that monthly buy signal and this type of breakout and then 3-week pullback with rising MA and against the pivot analysis improving, relative strength, this is a weekly chart, improving, volume momentum is improved, might be a trade that we look at and try to structure for a higher time frame move as we get into the, I guess, full-fledged gambling season. So this could be something that might be impressive, but DraftKings is one that also populated on our screens. So there are some interesting setups for the end of the month. By the way, PayPal is another one. We'll see if it formulates. And, if you want to say, does it deserve to be at $91? I don't think it ever deserved to be at $300, but I don't think in this environment, does it belong to be where it was in 2018? I think people still use a lot of PayPal, Venmo, et cetera, et cetera. And so maybe PayPal with a monthly buy, if we can get it to get back above its structured pivots. Remember, if a market's truly bullish, it'll be north of pivots. And so with a higher time frame monthly buy behind it, these are some interesting names that I think we can look at as long positions going into the end of the third quarter and into the fourth quarter. I hope this at least gave you something to kind of sink your teeth into, where we look for not just opportunities, but how we integrate our indicators together. And if you're interested in learning more about this, you've not seen me before in action, come visit us at a seminar. We've got one, and I'm excited about it because a lot of this stuff we just, I just breezed right through this. But it was 2 days is meeting other traders and seeing what their successes and failures are, and what the work does and how it may help them or not help them. I don't know, but hopefully it's helped a lot more people than not. That's for sure. If you're interested, click on the link up there, personsplanet.com. If it doesn't show up there, it should show up at least in the website. And if you're interested, I'll show you exactly where to find it on our website. This is the website. Just go up to seminars, trading seminar, click on it, and that's the link. It was a real simple link right there. And that's what we're going to be doing, and that's where we're going to be visiting again, which I'm excited to see that. So I want to say thank you for your time. I know we went 8 minutes over. I'm going to get in trouble for that, not from my handlers, but from my wife, because after 1 hour, the quality of the video tends to erode. So we're going to have to stop this right now. Thank you all very much for attending.